Hey guys, it's Crypto Llama here, and lately I've been getting a lot of messages from people telling me they're going to be cashing out their assets in Splinterlands. At the end of the day, you can only make that decision yourself, and everyone's circumstances are unique. But it's easy for investors to let their emotions get the better of them when markets are volatile or falling. For that reason, I wanted to go over a few rules here to ensure you're investing in any bear market the right way. Before I do that, I'm going to be giving away 100 SPS to the person who has the best Splinterlands journey story in the comment section below. Make sure you've joined my community Discord, which is in the video description below, as I will announce the winner in the giveaways channel 1 week from today when I'm streaming on Splinterlands TV. So guys, panic selling ensues when investors essentially distribute their assets to relieve themselves of the pressure of holding on whilst a wave of selling washes over them. Usually this is characterized when the market is at a bottom or seemingly going up and then straight back down in the days that follow. This can become extremely frustrating for the average investor, and it often leads to inexperienced investors liquidating their assets and removing themselves from the market completely. For the savvy though, this type of price action can present opportunity, which if you haven't seen my previous video on accumulation phases, be sure to check that out as well. Unfortunately, most of the time, fear is greater than reason, and the majority of investors will follow the crowd and just flip the sell switch. And this is because the fear of making losses far outweighs the potential of making gains, which is how inexperienced investors rationalize their decisions to sell, even though that's how their investment losses become real. Successful investing requires mechanical behavior, so I wanted to go over some key concepts that apply to any bear market. One of the worst things you can do in any bear market is make knee-jerk reactions to market movements. The average investor significantly underperforms the overall markets over a long enough time horizon. And the primary reason for this is moving in and out of positions too quickly. When assets plunge and seem as if they're going to keep falling forever, it's our instinct to sell before things could possibly get any worse. Then when bull markets happen and assets keep reaching newer highs, we throw our money in fear of missing out on the gains. We all know that the main goal of investing is to buy low and sell high. But by reacting emotionally to market swings, you're literally doing the opposite. For this reason, it's crucial to invest in assets that you want to own for the long run, because selling them simply because of the price action observed in a bear market may be detrimental. Next up is don't try and catch market bottoms. For the average investor, trying to catch market bottoms is generally a losing battle. One thing to keep in mind in a bear market is 99% of the time, you're not going to be investing at the bottom of a market. Buy into an asset once you've done your own extensive research on the fundamental analysis, including its white paper, risks, management quality, etc. Ask yourself why you're investing into a particular asset before you put your capital into it. Next up is building positions over time. And this goes hand in hand with the previous tip. Instead of trying to time the bottom and throwing all your money in at once, a better strategy during a bear market is to build your positions gradually over time, even if you think that prices are as low as they're going to get. This way, if you're wrong and the asset continues to fall, you'll be able to take advantage of the newer lower pricing instead of sitting on the sidelines. This one is incredibly important, guys, and as a general rule in all your investment endeavors, you should never put more into the market than you're willing to lose. Investing is important, but not as important as eating and keeping a roof over your head. It's flat out bad manners to take funds you need in the short term and invest them. As a general rule to most, you should not really get involved in investments unless you have a long-term investment schedule. And you should never invest money that you can't afford to lose. Another question I get asked a lot is whether people should sell A to get B. The simple answer to this is diversification. If you find yourself losing sleep over the potential loss of value of your portfolio that you might sustain during a bear market, it's possible that your portfolio is not balanced in a way that's appropriate for your needs and circumstances. You can mitigate market risk by hedging your portfolio through diversification. For instance, if you're investing in crypto, it would be prudent to allocate a portion of your capital for a variety of assets that have a low degree of correlation with the the crypto market. One way to do this is simply by using correlation analysis. This way, a loss in one asset can then be offset by the gain in another. Remember that a portfolio that has highly positively correlated assets is open to getting wrecked in the event of a market downturn. This next one is huge if you feel like you get heavily influenced by others. Chatter can create momentum around investments that fuel uninformed buying and selling from inexperienced investors, making you vulnerable to loss. It's important that we're honest with ourselves with our level of expertise. As you start investing your capital, be sure that you're also investing your time in expanding your financial literacy. A simple rule of thumb is here: don't ever take financial advice, not from me, not from anyone. Although this next tip may sound strange, it may be the reason why you make a gain instead of a loss. Play dead. During a bear market, the bears rule and the bulls don't stand a chance. By staying calm and not making any sudden decisions, you may save yourself from becoming a larger operator's fodder. If you find yourself getting overwhelmed by it all, tune out, ignore it, play dead. Furthermore, most of the people who fall victim to panic selling check the performance of their investments far too often. The more frequently you check, the more tempted you'll be to take action. Try a more mechanical set and forget it approach if you've already done your due diligence and researched the asset anyway. Although this one may sound like complete rubbish, it was when I learned to do this that I became a more successful trader. Learn to manage your emotions and psychology. There are many amazing books on this topic, and if you're interested, just hit me up on Discord. But you'd be surprised just how important the psychology of investing is. Managing the volatility of our emotions is more important than the volatility of our markets, which you just can't manage at all. High levels of bearishness are usually a sign that just about everyone who is inclined to sell their assets has done so already or is in the process of doing so. This is also when all of the doomsday specialists come out of the woodwork and start predicting further moves down. And this is a classic indicator of market bottoms. It's psychologically challenging to remain committed to an asset in the face of overwhelming negative sentiment. But research and history has proven time and time again over a sufficiently long enough time horizon, even the biggest drops look like mere blips in a market's long-term price action. This next one is something we should all come to terms with. We should view bear markets as normal market conditions that will come and go, and not a downturn that's gonna just last forever. Our brains are not wired to accept losses, so our natural reaction to losses during a market downturn is flight, not fight. And panic selling is driven by fear, market sentiment, and short-term noise. Just remember though that market corrections and retracements are part of the process and are completely natural. Having operated through bear markets before, at times like this, it's crucial to be stoic and emotionally intelligent. But above all, focus on the things that you can control, like some of the suggestions in this video, and let go of the ones that you can't. At the end of the day, fear and greed are base instincts that drive investment behavior, and it's not easy to remain calm in highly volatile markets. You'll minimize the chances of panic selling in the long run though, if you follow some of the things in this checklist. And that's it for me for now, guys. If you enjoyed my content, please like and subscribe. Don't forget to also participate in the giveaway by sharing your Splinterlands journey story in the comment section below. But other than that, I will see you on the blockchain.